But I did say, didn't I? I was going to ask you about your 3 investment predictions for 2021. And I think we should underline the word predictions, right? Because it's not advice, but just your view as somebody in the industry.
Well, I haven't got a crystal ball, and there's so many imponderables in this market. I've never, in my over 30 years trading the market, I've never seen a market which is more rigged than this one. And
Okay.
I say this, and I don't offer any apologies for saying, because it's completely rigged. It's a market that is rigged by the big banks and by governments with all this quantitative easing and printing of money. But leaving that aside,
Well, I was going to ask you. I mean, that is a powerful word to use.
yeah, but it's true.
Okay.
It's completely rigged,
Fair
in
play.
my opinion. You know, and it's rigged, and we have artificial low interest rates and money printing, and you know, the governments are buying their own paper in the marketplace to avoid. It's just absolutely crazy. But my 3 bold predictions for 2021.
Come on.
I expect the precious metals, particularly gold and silver, to outperform all the other asset classes. You know, in times of economic uncertainty, gold and silver provides a safe haven status, and then you've got the risk of reflation. So it's a hedge against inflation too. I think the gold miners trade at a significant discount to physical gold paper, and are also a very good opportunity. Let me explain the reasons, and this might interest the US listeners, why I think gold will do well.
Yeah.
The amount of liquidity that has been injected into the monetary system to prevent the economy from collapsing. I think budget deficits have skyrocketed to its highest level since World War II. We expect deficits to widen further and to reach record highs, and we see loose monetary conditions as being a major catalyst for gold buying. So that's one reason. Secondly, the injecting of massive liquidity into the financial system weighs heavily on the greenback, on the US dollar. The US dollar index has already lost 11% of its value in 2020 relative to a basket of foreign currencies. And we see that continuing over the next year or two, because the US has twin deficits, a balance of payments trade deficit and a budget deficit. And those 2 things tend to weigh on the currency. So my prediction is that the US dollar will lose over the next 2 years another 10-20% of its value relative to this basket of foreign currencies. Third, history tells us that every time we've seen a weakening of the dollar, it's always been positive for gold. So we go back to the 1970s, the gold price increased 20-fold, 2,000%, during a period in which the dollar lost 30% of its value. And more recently, in the 2000s, you know, just before, well, up to the global financial crisis, the dollar lost 40% of its value, and gold increased 6 times in value. So there's already precedence there, and historically you see that gold will perform well in, you know, at times when the dollar is losing its value. The other thing to bear in mind is that we have $31 trillion of government paper, fixed income assets, which are producing a negative yield.
Yes.
Negative yield, right? So you're holding assets, government paper, and you're not getting anything, because if you take away the inflation rate from the yield, actually you're losing money holding the paper, right? Wouldn't it make sense then to hold gold, which doesn't provide a yield, but doesn't give you a return unless it appreciates in value, but doesn't produce a negative yield, right? So I think it provides a great hedge against inflation, where we might see some reflation further down the line. And then the other thing, fifth and sixth. Fifth, we are seeing negative real rates across the entire US yield curve, but not the 30-year Treasury bond. Now, at the long end of the curve, every time that the 30-year Treasury bond has yielded a negative return, and it's happened on a couple of occasions in the last 50 years, a powerful bull market in gold has ensued. And if you look at the yield curve, at the top end of the curve, we're still positive yielding, right? Should that go into negative, that could be a major catalyst for gold. And then sixth, and I think the most important, is that due to the growing mountain of debt, there might be a global financial reset. So central banks of leading economies have been building up the gold reserves in the last few years, in light of the fact that we're seeing a debasement of the fiat, the so-called fiat currencies.
Indeed,
So
yeah.
they're building the gold reserves. Now, the interesting thing is, one way out of the crisis is what we call the global reset, right? If the price of gold, if they're building up their gold reserves and the price of gold were to increase 5-6-fold, then the value of those reserves would soar, would increase significantly.
Yeah.
And maybe part of that could be used to repay the debt.
Yeah.
So I think positioning yourself in gold at this point in time sounds very, very smart. And of course, silver always follows suit. Silver is much more volatile, but normally trades historically 60 ounces of silver for 1 ounce of gold.
Okay.
And, you know, if gold goes to 3,000, then you expect to see silver trading at $50 an ounce, and it's trading now at 19. So you can see how much upside it has. And then I mentioned the gold miners. Why do the gold miners offer great potential? The case for investing in gold miners relative to gold has never been better. The gold producers are delivering record earnings, and that's because extracting gold from the mines has never been more profitable because the price of gold has gone up, right?
Yeah.
They've been paying back their debts, so they're reducing costs and debts, so they're cash flow positive, and they've been increasing dividends. So if you look at the price of gold miners relative to the gold price, it's at an all-time high. So potentially it could go up 150% from these levels. So gold, silver, and gold miners have excellent long-term potential. Now, my second prediction, and not diverging too much from metals, but this is moving from precious metals to industrial metals. I think we're entering a new bullish super cycle in industrial metals, such as copper, palladium, and nickel.
Yeah.
And there's a few reasons. Firstly, investments in infrastructure. We've seen China with a massive infrastructure spending program, which started last year, which is why China has been the only one of the few economies that has posted positive growth in 2020. The economy grew 2.3, but that's why they went into infrastructure spending. And now we're seeing the Biden administration sanctioning a 1.9 trillion, I think it is, infrastructure spending program. So infrastructure consumes a lot of industrial metals, right? So this is why industrial metals will be in demand, because they consume a lot of copper and iron ore and all those base metals. And the other good thing going for industrial metals is electrical vehicles.
Oh yes, of
We
course.
know are coming in 2030.
Yeah.
The fact that the need for renewable energy production and battery storage. So commodities have always been more cyclical than other asset classes, and they go through these cycles over periods of time. And if you look at the CRB commodity index graph, you know, you can see how volatile they are. The commodity index increased 400% during the period 99 to 2008 during the global financial crisis, but then has lost subsequently in the last 12 years 80% of its value. So it's gone back to pre-2010 levels. So amazing opportunities in industrial metals. I mean, our clients are invested in nickel, invested in copper in particular, and in palladium. And look at the electrical vehicle market. I think we are at an inflection point. Look at most prospective buyers. They want the next car to be electric. So there's going to be an explosive demand for base metals due to energy storage requirements. Copper offers amazing opportunities, but if you look, I've got all my graphs here, and I don't want to go through them because, you know, I can be here for the next hour. But the Bloomberg New Energy Finance, according to Bloomberg, New Energy Finance says that nickel demand for electrical vehicles is expected to explode 14-fold up to 2030.
Amazing.
But if you look at the demand and projection for base metals, nickel, aluminium, phosphorus, iron, copper, even graphite and lithium,
Lithium,
unless,
sure.
unless I extend cobalt because it's losing its its appeal as part of the new batteries for electrical vehicles. The need for cobalt has decreased. They've
Yeah.
found substitutes. So cobalt and manganese is less in demand, but all the other base metals, we are talking about, tenfold increase over the next 10 years.
Amazing.
I'll give you an example. For a typical electrical vehicle, you need 120 pounds of graphite.
Mhm.
And significant quantities of nickel, cobalt, and lithium. The average solar project requires about 5 times as much copper per megawatt of capacity as a conventional fossil fuel. Offshore wind farms demand about 10 times as much. So I think we're in a boom in electrical vehicles, renewables, and energy storage, and that will propel all those base metals. I can see copper, nickel, and palladium increasing tenfold over the next 9 years.
Amazing, Paul. I'd not heard of palladium. I thought it was a building rather than a precious.
No.
Okay.
And my last prediction:
Yes, number 3.
clean energy and solar power in particular. I think they will produce the best returns. The
Yeah.
world has been relying on dirty fuel to produce electricity for over a century,
Yeah.
and although it's relatively cheap, it's a heavy pollutant, and everyone recognizes that.
Yes.
Um, and but according to JP Morgan, the global demand for battery energy storage, I go back to battery energy storage, is expected to increase 100-fold
Mhm.
from now to 2030. Now, look at solar powered energy production. Today, it accounts for 7% of global power production. Solar power, 7%. By 2030, the International Energy Agency expects that to increase 5-fold to 38% of global power production. By
Yeah.
2040, it's 66%.
Wow. And that need has to
So
be met, right?
that need has to be met. And so there's going to be global demand. Now, my 5 reasons why solar power companies will perform extremely well over the next 10 years. First, the cost of solar power will be lower than oil for the first time by 2025. Right now, it continues to be more expensive.
Mhm.
And so long as it's more expensive, we have this addiction to oil. As soon as it becomes cheaper, we'll go to cheaper alternative sources, which is solar, right?
Yes.
And we're getting close now. We're 4 years away. Secondly, the European Green Deal aims to have 0 net emissions by 2050. So there's going to be increased reliance on solar power. So this requires a doubling of power generation from renewable sources by 2030.
Mm.
President Joe Biden is already authorizing passing a clean energy bill and increasing solar subsidies, and that's worth 2 trillion. So that's going to catapult the demand for solar power in the US alone.
Yeah.
And the US clearly is a leader for the global economy. There's growing interest in sustainable energy from big investment houses globally. So more capital will flow into solar and wind power. The big investment houses will set up investment funds and more money will flow into that. That will be a major investment trend. Keep the money flowing, developing the technology, but producing these amazing returns. So I think we are in the cusp of an energy revolution. And I think solar provides a massive investment opportunity for long-term investors who can stay the course
Mhm.
and who accept the volatile nature of the sector. But for me, 2021 and beyond is about, and I think we're in this super cycle, it's about silver and gold, because I think we will, this debt is unsustainable. I see the industrial metals that I mentioned now, and I see solar power as being a big investment theme, and one where investors can make a lot of money if they're patient.
Thank you for being so bold there, Paul. That was very interesting indeed. I'm sure of great interest to our audience here.
I'm sure that someone will hold me to account in 12 months.
That's your job. That's your job, mate, isn't it?
And you've taped it, Carl.
Yes,
I hope you never play that again.
It's going to be on the on the internet, for eternity, as I told you before. So,
Thank you.
But intuitively, it sounds right. I know you shouldn't use that as an investment tool alone, but it makes a lot of sense what you've said tonight, and I'm sure it has to other people here. I know we need to let you go.